Now, when a bank makes a loan, it creates money by depositing a credit on your demand or site account. And then you, as a borrower, can write a check or tell the bank to make a money transfer. And then eventually the money comes back to you through your business and the loan is retired. And Fisher said, stop to this, put a stop to this, make it 100% by issuing it through the Federal Reserve. And then every depositor in the United States that gets a loan must get Federal Reserve money backing for his demand deposits that he has in the account.
You mentioned credit. You said instead of every bank in the states creating this money, you had the Federal Reserve crediting. Does it mean the Federal Reserve was creating that money and giving it to the banks, lending it to the
No,
banks?
no,
What
no.
does it mean?
That's what they are trying to do now with quantitative easing. But let me explain to you, when you go to the bank, the credit union, Vancouver Credit Union, you take $1,000, your pension, and you put that in cash. For some reason you have cash. Put it into the teller, and he puts it into your account. It gets credited on your account.
Mm.
Now, when you go to the same bank and say, I need $10,000 of a loan,
Mhm.
then it also, the 10,000 gets credited to your account.
What
But
is
there
what
is
does it mean credited? What does it mean?
a
Somebody puts
deposit,
them, somebody
then you have
deposits,
11,000.
somebody
Let's say you,
deposits $10,000. The bank deposits ten
the bank
thousand
does.
dollars.
The bank
Oh,
does.
where do they get that from?
They don't have it.
Oh,
This is my whole,
s- s-
this is the whole scam.
so they
The
create
banks
it.
don't, that's right.
Mhm.
They don't put $10,000 cash into your account because they don't have it, but they debit, they use double entry bookkeeping as a device for this counterfeiting.
Okay.
They debit, if you understand bookkeeping a little bit, they debit loans receivable, so
Yeah.
they call that an asset. And then they credit your account, so you have now $11,000. And then you go to the car dealer and say, I want this Toyota. Uh, how much is that? And they say 11,000. Then you write, give them a check. The Toyota people go to the Canadian Imperial Bank of Commerce, CIBC, and they present that check. The CIBC gives it to the Vancouver Credit Union through the clearing system and says, pay us. They say, okay, we pay you, but you pay us also because we have a check against you. And so this is the way, by way of offset. You give me a check, I give you, bank, a check, and then we settle only the difference, the 99 cents maybe, that in the clearing system of the country as a whole remain unsettled. But now comes the Bank of Canada and says, don't worry about it. We put in the money for you for 3 days. Hopefully it'll change tomorrow and it goes, you're over, you're under, adverse balance, as we call that, or surplus. So the fictitiously created money actually works
Mm-hmm.
because every bank does it,
Mm-hmm.
and they send to each other and they credit each other. But the only cash that they ever have is the Bank of Canada $10 bills, $100 bills that they have very, very little of.
Mm-hmm.
Now comes Irving Fisher and says this cannot happen because deposit banks can only have deposits if they have cash in the vault, enough cash or credit at the Bank of Canada or the Federal Reserve or the ECB, the European Central Bank. This is Irving Fisher. He says, no more money creation by the banks out of nothing by way of bookkeeping. Stop that.
Life has always been a challenge. When one has a problem and wishes to solve it, first one must determine what is the root cause of the problem. Simple problems have simple solutions. Complex problems are, well, more complex. An obvious problem with our current financial system is that it rewards greed and corruption. Greed and corruption seem to be everywhere. But are greed and corruption the root causes of the problem, or are they the result of the way the system is built? Logically, one should first ask, are there built-in reasons why the system works the way it does? And if there are, can they be built out? Some say the basic reason the system is unstable and leads inevitably to corruption is the charging of interest. As explained earlier in this series, in our current bank credit as money system, the principal amount of a bank loan is simply created from the borrower's promise to pay back the principal plus interest in money. But the money to pay the interest is not created. The obvious but untrue conclusion is that it would therefore be mathematically impossible to pay off all debts. Many who call for money reform call for the abolition of interest as the solution to the problem. But is interest really the problem? Yes, there would be a serious mathematical shortage if all loans were concurrent and had to be paid back in one lump sum. That problem might apply to gangland loans and sometimes to farm loans, but that's not how the banking system works in general. Bank loans usually get paid back in a series of payments over a period of time, and for good reason. Money is both a stock, the amount in existence at any one time, and a flow, the transactions over time that the money is used for. Flow works like this. If I, the rich guy, lend you $1 and that was the only dollar in existence, the stock, could you pay me back $100? Well, if it had to be paid in one lump sum, no. That other $99, the interest on the loan, would be impossible to pay. It would be impossible to pay even in $2 payments, because there is only $1 in existence. But if I let you pay me the $100 in $1 payments, magic happens. In fact, in $1 payments, you could pay me back any amount of interest if you lived long enough. The only condition required to make full payment of a $100 debt with only $1 in existence is that I give you the opportunity to earn or otherwise get that dollar back each time you pay it to me. This is the flow. And by means of the flow, the same dollar can be paid any number of times and becomes effectively many dollars, all legitimately representing the work done to earn them. It is always the work, the real value, that pays the debt and gives the dollar its value, not the dollar itself. The relationship in our example is dreadfully unequal because the man with the money has enslaved the man without it, just like the real world, some would say. But a simple loan at interest need not produce a shortage of money or cause unpayable debt if flow is 100%, as in our example. Flow is the real measure of economic activity. It's much more significant than the stock in a money system, as it multiplies the effective money in circulation. Given that today we use an exclusively debt money system, what is flowing in all these transactions is credit or promises to pay money. This credit is ultimately nothing more than the promises of borrowers to pay this credit back, usually according to a time schedule and usually with interest added. To pay this credit back, most of us will have to work and earn it by being productive. So, therefore, the real value of the money that flows in our economy today is created by our promises of future productive work. We take a loan in order to have something now rather than later. We agree to pay interest on into the future, thus reducing our future spending power, often by more than the amount of the original loan. However, with an understanding of flow, we see that there's no intractable arithmetic problem with the charging of interest. The problem is a social and systemic one. Lenders have neither obligation nor incentive to spend all their interest income so that the borrowers can earn it again and again. In fact, money lent once into existence is lent as existing money a second and a third time in expectation of more gain. The problem is basically one of incomplete recycling. Where money needs to be spent, earned, and used to extinguish the debt that created it, it is instead lent or invested for gain. In other words, money that must be extinguished is, instead, expected to grow forever.
Can you explain a little more about what is this? You said Bernanke borrowed money or borrow bad bonds from the government, and how is that the government is creating that money then to lend it to the Bank of Reserves?
Yes, the latter is correct.
Mm-hmm.
Every bank can make deposits.
Mm-hmm.
That's part of the banking license. But the Federal Reserve or the Bank of Canada are the only ones that when they create money, it is the high-powered money. It is withdrawable in cash. They create legal tender. They're the only ones that create legal tender.
Mm-hmm.
And what the Bernanke did with quantitative easing was he bought in the secondary markets from various banks the U.S. national debt.
Yeah.
And when the Federal Reserve buys, or the Bank of Canada buys, being a government agency, they buy it from themselves.
Mm-hmm. Mm-hmm.
So that is a benefit to the taxpayer. There's no interest payable on this.
Yeah, I still have something that's not clear in my mind still, and it's that if the banks have this ability of creating money to lend it to borrowers, why do they have to borrow money from the government of the United States? Why do they have to borrow and the government has to create money to lend it to them when I understand the banks can create their own money?
Okay, maybe we should be more careful with when we say money. The banks create money is what we say because it's deposit. We should correct ourselves in the use of our language and say the banks create deposit credit, but only the Federal Reserve creates money, meaning legal tender, which has to be accepted if it is in the form of a bill.
So there's billions of dollars that the Bank of Reserve borrow from the federal government. Is that cash printed money or is that just a number in the computer?
That is a number in the computer, but of the high quality computer, which means anybody can withdraw that credit at the Bank of Canada or Federal Reserve as cash.
Mm. What is the difference if I go to withdraw some money? What is the difference to me whether it's high power money, Federal Reserve money, or it's just bank created money? How is the bill that comes out says that, or what is the difference to the regular client?
In good times, when the clearing system functions like today it does, there's no alarm bells, nothing. Mm-hmm. There is no difference in practical terms. Mm-hmm. There is a difference in the national debt way of terms, that because you're using bank money, bank deposits in payment of your Toyota or your rent, the federal government has that big debt because they are prohibited from putting their debt in the form of central bank notes into circulation. This was Irving Fisher's proposal. It was tried again and again, and the bankers always run up against, they are like the secret government behind the elected government, the bankers, and with all their money power and all their influence. They do not allow the Bank of Canada to provide the money to the federal government to spend it into circulation. They say no. The federal government, if they are in need of money because they have a deficit, they must borrow from us bankers. You see what I mean? So we have the bankers standing in the way of national welfare programs, national housing programs that cannot be done, or to help the poor, or infrastructure or education that cannot be done because the federal government pays so much interest on bank created money, and the banks created out of nothing.
All right, so this is the government borrowing from the Bank of Reserves. The same as in Canada, the government borrowing from the Bank of Canada, from the other banks to pay for their deficit or their debt.
Yeah, Canada has the same dilemma, and so has the rest of the world. Switzerland is in a little bit better situation because they create more money for the benefit of their own government than does Canada or does the Eurozone. We have two types of money.
Okay.
One should not even be called money, which is that which only shows on your bank book. It has no cash equivalent anywhere. And then we have the cash that you have in your pocket.
Okay.
And the banks have cash in their vault. And that cash comes only from the central bank. So the 100% money of Irving Fisher and the Chicago Plan says no more bank-created deposit money. Put a stop to that. We want the federal government, through its own agency, which is the Central Bank of Canada or the Federal Reserve, we want our own federal government to use their money power under under paragraph 1, section 8 of the U.S. Constitution. The Congress has the absolute money power.
To create
the
money.
Congress should act to stop the banks from creating the money.
Perhaps the most significant problem with money as a single commodity is its tendency to concentrate wealth. Those who have no money must get it from those who have it to lend. Anyone with extra money can lend it at interest, and if, rather than spending all of the interest, they add any of it to their lending capital, they will accumulate even more money to lend. One reputable study counted all the ways we pay interest, directly on our own debt and indirectly in prices and taxes for corporate and government debt. This was compared to the interest we earn from all sources. This study found that only the richest 10% come out ahead. The next 10% do little better than break even, and the remaining 80% pay more than they receive, the poorest losing out the most. Now, in our current bank credit system, money is created as debt to banks. This debt is required to be repaid to the banks in money, either fiat cash or bank credit. Therefore, the ability of all borrowers to repay depends on the availability of fiat cash or bank credit. The supply of fiat cash is controlled by the nation's central bank, but fiat cash makes up only a very small proportion of money. Usually about 95% of all money is bank credit. And who controls the availability of bank credit? The banks? Well, on the one hand, what the banks can do is constrict the supply of credit any time they want to, with high interest rates or by just not granting loans. On the other hand, the banks can lower interest rates and encourage borrowing, but they can't expand the money supply unless borrowers are willing to borrow. If cautious and reliable borrowers are in short supply, banks must take bigger risks, as interest must be paid to depositors and banks cost money to run. The bank credit money supply is, as they say, highly elastic. And because it's based on the willingness of borrowers to borrow and the reliability of borrowers' credit, it is vulnerable to both rapid expansion and drastic shrinkage. Also, everyone is legally obliged to pay in money. Now, money in reality is just an accounting of debt. And accounting follows strict rules, so the whole situation is governed by inflexible numbers. That's why a sudden shrinkage in the money supply caused by some defaults has the inevitable follow-up effect of causing more and more defaults and even more shrinkage of the money supply. This self-reinforcing downward suction leads us into economic collapse and the economic and social absurdity of unemployed, dispossessed people camping outside their empty, vandalized homes. And what does the government do about it? It loads bankrupt taxpayers with astronomical fantasy debt that will never even be reduced, never mind paid off. All this is done to fill up the negative balance sheets of the banks with money the banks never had in the first place. And then they use it to pay themselves obscene bonuses. Life is good for those who know how to play the system. The bailout scam was the biggest daylight robbery in the history of the world. So far.
So who is keeping us from living in this world without bankruptcy, because we have an abundance of everything? Food, water, transportation, it's all there. But 3% own 97% of the wealth in Thailand, where I'm speaking from. In the United States, 10% of the people own 75% of the productive resources. In Canada, it's not quite as bad as in the United States. So why do we have this? Because these interests of the filthy rich are the ones that are also running the banks, and they help each other to keep the system so that the poor will always stay poor and get poorer. The federal government can never create its own money. The Republicans will prohibit this, and the Democrats have no courage.
Okay, you say that the government has no power to create money. Yet when the banks were in crisis, didn't the government lend them money to come out of the crisis, in the States as well as here in Canada?
Yes, they did 750 billion US dollars on TARP.
Yeah, and here in Canada too.
They bought the bad assets.
But how did they buy? The government created money then to buy those assets.
Not the government. The Federal Reserve created the money, or the Bank of Canada created the money. And the Bank of Canada then bought, or the Federal Reserve bought the bad assets, or they gave it to the congressional unit that used that money to buy the bad assets. Otherwise, Citibank and Bank of America would have been under.
Okay, so yeah,
we were at the brink of a total crash of the banking system.
Could we go beyond money as we've known it? Could there be a new basis, a fresh concept, a design that could more effectively address the real purpose of money in the 21st century?
You have another little section in your book about this tribe in Africa. I think it was Botswana, where for many years the tribes there did not use money at all. Do you envision something like that happening, and would that be a solution to all the money problems, to just do away with it, say no more money, to each according to his need, from each according to his possibility?
Absolutely. I think that well, I was growing up in a situation like this during and after the Second World War.
Mm,
We had potatoes every day.
mm,
We had a few vegetables and meat, a little morsel on Sundays only. So
mm,
we were healthy, lean. I wouldn't say mean.
mm,
And where I live right now, I am absolutely self-sufficient. So my need
mm.
for money is only about $500 a month.
Yeah, yeah.
But now think of the people in New York. Think this is 20 million people. Think of the people in Chicago. Think of all these paper pushers that
Mm,
all of a sudden they would not have any tomatoes. They
mm,
would take their guns, use the gasoline that they have, and they would raid the villages and the farmers
mm, mm,
and take their place.
mm.
After all, they're chimpanzees with 3% human genes, so they're monkeys.
So you think that
This is the
it
problem.
would be very chaotic, especially in big cities, if money did not buy things, if we start just sharing what we have without any
Well,
price.
the hope is on the way.
Mm,
And what is on the way is that you and I have our jobs, totally competent functions that we can do from our home because of the IT technology. And so my hope is that eventually New York will un- unpopulate instead of
mm,
overpopulate itself. There will
mm.
be no more jobs there. What for? Everything can be done by
Yeah,
computers, by you from your home. And then we can have a little garden, and then we can have less of a threat from these mega cities emptying.
yeah, yeah, yeah. So that probably would happen automatically. But you see that as a possibility, a future civilization with no money?
I think we have to find a solution towards that end because money is an abstract. It really has no value unless you tender it and somebody uses it to tender to somebody else and it circulates.
Mm,
It's a medium of exchange only. How can we make that exchange? We could say all the water, all the telephone, all the transportation is for free.
mm,
And people who have a job in that system are also privileged,
mm,
which means we got to get rid of this idea of amassing wealth,
mm,
of having a home with 20 rooms
mm,
just for your wife and the visitors.
mm,
That has to end. And there's nothing wrong with the Volkswagen Beetle.
mm,
You don't have to have an Oldsmobile station wagon with 6 liters.
mm, mm.
I mean,
So there's hope for people to change our habits, our bad habits. Good. I hope that happens before
I
our before we go.
I think our well, I don't have any hope in that department, but I think the real wealth of each one of us is in our head, our knowledge, that we
Mm,
have so much material wealth.
mm.
And that is a misconception because it can evaporate in 1 minute.